So now I don't even want to waste any time. I want to get to the elephant in the room. You have this method. You're telling me here a mortgage is reduced from 30 years to 8 months. And so I'm sitting here saying, how? And I've studied some of the behind the scenes here, but bring our audience into what's the method? Is this a kind of a philosophy that you have with finances, with making the money move? I want to get into how you think about money and then how you tactically do some of this stuff, Howard.
Yeah. So let's just say, what's the tool that we're using that, my first client went from 30 years to 8 months. The whole tool is a line of credit.
Okay.
Okay. And
Many
so
people
when
have heard of that line of credit. Yes, and essentially, line of credit for anybody that doesn't know is, everybody's used to credit cards. Line of credit is just a large credit card from essentially a bank can give you access to. That's how you would say it, Howard?
Yeah. I mean, that's the thing. A credit card is probably the easiest example to think of in terms of money is moving in and money is moving through this open-ended instrument.
Mm,
That's the key, is that it's open-ended, because think about a mortgage. You put your payment in, and how do you get it out? You can't. It's
you cannot.
locked up in the titanium safe.
Hmm.
But with a line of credit, and the reason why, and when we're talking about a line of credit in this case, we're talking about a home equity line of credit. So if you want to think of a gigantic credit card secured by your house, that's what this is. And so a line of credit being open-ended, I now gave you the key to this titanium safe.
Mm.
And
That's
so,
I think that's a huge concept to grasp there too. You had talked in your presentation, Howard, of the what's right in front of us can sometimes be the answer. And for most people, every month, your mortgage is the one that's right in front of you, staring at you on the first of the month. And as you just explained, a mortgage as a financial instrument is locked. It's a locked box. You put things in and they don't come out.
yeah,
In
do you
your,
know
your
what do you know what mortgage stand like the definition of a mortgage is?
no
It's a French word. It means death pledge.
death pledge. That, that's a takeaway.
Yeah,
Mortgage
I
death
mean,
pledge. So the jokes are true. You're
yeah,
on the mortgage is death pledge. Okay, so literally we're talking about, you're talking about it's locking you up. What's more locked up than you're in your death pledge? I'm going to
right.
start calling it that.
And so but let's step back a second and say the reason why mortgages do work is it's a fixed interest rate. And for most people, they're like, I make X amount of dollars a month. What fits within my budget? And so they have to have a fixed number, a fixed payment that they know works within their budget. And so that's it. And then the banks have figured out, well, how long can we stretch this out for so it's a reasonable payment for people? And we don't even have to delve into all of the math, but 30 years is a freaking long time. Okay.
Yes.
But just what drove me nuts the first time that I purchased a home, I'm just like, I'm looking at this saying, when am I ever going to pay this off? I mean, it was just like this, it drove me insane because of the math brain that I have, that I was like, this is going to take forever. And I know some people say, oh, the interest is front loaded. It's like, no, it's just math in terms of you want to stretch this out over 360 payments. You're just slowly ticking away at the balance. And what we're doing instead is, because we now have the key to open up the safe, we can put not just how much of your payment goes towards the balance, we can put all of our income towards the balance.
Hmm.
Because when you put all of your income in, what are you doing? You're lowering the debt, obviously. And when you lower the debt, you're lowering how much interest you're charged on a daily basis. But the whole key of the line of credit is the open-ended nature, that if I put $10,000 in tomorrow, I know I can get $10,000 back out, and I'm not freaking out in case I live in Central Florida and there's a hurricane that comes through my way. I
Hmm.
can get the money back. That's the whole magic of this.
Gotcha. Yes, the key to the titanium box, the death pledge box, we'll call it, is the line of credit. That's the liquidity.
Yeah.
Now, I want to bring it down to size here immediately and get into kind of a fundamental example of this. I want to use, maybe you can use one from that you've talked about in the past, or even just make one up here. But let's put this into practical use here.
Yeah.
With you have a mortgage, or I know you've talked about a business being able to unlock lines of credit too, because obviously you have personal cash flow in your mortgage, and then you could have business cash flow and business lines of credit too. Those are kind of interchangeable, Howard.
Yeah, I mean, well, the idea in the system and the concept is interchangeable, but obviously a business is a business. It has its own EIN number, it's its own entity. You want a line of credit specifically for that versus your personal life. So there's
Yes.
Kyle the businessman, Kyle Reedstrom, the family man. And so we want to kind of separate those out. But yeah, I mean, I'll just kind of give you some examples, obviously keeping some confidentiality here, but being a dentist in my background, I've kind of attracted some dentists to the whole concept. And let's not kid ourselves, dentists can do pretty darn well. All right. And so I came across a dentist. They live in Tornado Alley. So you can figure out one of the 10 states that they live in. And when I asked he and his wife, what's your dream? He could not get out fast enough, be debt free. Okay. So in his business, he stocked up just a wad of cash, just way too much. And because of buying the practice and buying the building, he was at about $1 million of debt. And so I had to work with his bank to have them feel comfortable with the idea of what I was doing, because I had to get them involved. I don't provide the lines of credit, but I have to come from a perspective of, look, I know you need your safety to be able to do this of what we're asking. And they went with it. Long story short, he started out at $470,000 of debt with this one specific loan. And in 4 months, we're down to about 200.
Wow.
And we're just slowly ticking away. I reached out to the banker, said, happy with everything? She's like, absolutely thrilled. I asked the dentist, how are you feeling? He's like, this is great. I can't wait until they let go of some of the other money that I can do this even faster. I said, no, hold on. We had to kind of set aside kind of like an escrow type of thing for them to be comfortable for even us to do this. Let's give it a couple more months. But I said, most importantly, I said, have you felt any stress with doing this? Have you ever felt that you were constrained with money? He said, not 1 second. And that's the thing, is that we set things up that he still has access to money. Because the last thing you want in your personal life or your business life is, I have no cash on hand.
Yes.
I have no access to cash. And that's when you freak out, rightfully so. You freak out because you're like, what do I do? Now I feel like I'm trapped in a corner. I always try and set this up that everyone feels just a lot of flexibility. Here's another great example.
Well, Howard, let me jump in on this example quick, because
Yeah.
I just got to follow it myself. And so there's $1 million of debt. He's used that debt to buy the asset, which is his practice, right? So that's a money making asset. That's smart. That's leverage. Yep. Now, in my head, he has obligations to that debt. He has maybe that debt's made up of 2 or 3 different loans. Like you said, one of them is 470, and he has a payment that he has to make on that debt, right? And is some of that his mortgage, by the way? Because I know that mortgage payment is usually higher.
Some of that is the mortgage, if you want to call it a mortgage. The mortgage on the building is rather low. The rest of it was, the overwhelming amount was the practice loan.
Okay, and that's maybe, so those collective have a monthly burden, a payment that you have to attack every month, right? That $1 million, and that's the mountain you have to climb every month. That's the stressor, really.
Right.
Um,
I mean, here, just the practice loan as they set it up for him, just the practice loan, not even the building, was about $11,000 a month.
wow. So yeah,
And
his
when
practice isn't even black until he's crossing that payment, getting out of that payment. Yeah.
Yeah, and because of how we re-engineered things, and the banker pulled a little bit of strings that for stuff I didn't even ask for, she went for the first 12 months just to see that this would work, just interest only on this
Mm,
lower amount. So he went from an $11,000 payment down to like $1,300.
yeah.
And now the
Yeah.
rest of that money can now go attack the principal.
That's the part right there. Okay, so everybody's seeing the pain here, including me. This $11,000 burden that he's just crawling. He's having good months, bad months, whatever. That's the one that's looming. Then you go and get this line of credit. You talk to the bank. Which a lot of business owners, if you're working with the right people, you can have this conversation with the bank. You say, "Hey, we want a line of credit. How much of a line of credit did you get this specific scenario? How much did you guys ask for, and did they give you less? Or it sounds like you had to put some money
Yeah.
into an escrow to get it."
Yeah, for the bit. So this business line of credit, it ended up being around 300,000, but we had to put 200,000 in escrow.
Wow. Okay.
And so again, but this goes back to that idea of going to the bank and saying, look, we're doing something that is not within your box. How do we keep you feeling safe,
Yep.
but know this is going to work? And that you give us enough latitude, because realistically, what were they on the hook for? 100 grand.
Yes. Yes. And I have seen this in the real estate investing world where a lending institution will go and approve a builder or a developer for a large line of credit, and they will say, "Hey, we would like a little bit of a savings account or an escrow account that we're going to hold as collateral." So I like that's a familiar concept to maybe some, definitely me. So now you've still got this loan, you've still got this payment, and now you've got this $300,000 line of credit. We've got the tool, we've got the key. So now I just want to dive in, and thank you for going through this step by step with me.
Yeah.
How are you starting to unlock this? Now,
Okay.
like, what's the next step now?
Yeah. So for this dentist, he's doing very well. Okay. So now we brought his overhead down from 70,000 a month to 60,000 a month, but rough numbers, because now we went from an $11,000 fixed payment down to like $1,300. Okay. And so let's split that 60,000 now into 30,000 every 2 weeks to pay the team and all of that stuff.
Okay.
Okay. His collections is right, let's just about 140,000.
Okay.
Okay. So every 2 weeks, he's collecting 70 and he has to pay overhead of now 30. So here's the magic of what happens. We pull $30,000 out of the line of credit, because this is where a bank goes nuts. They're like, we gave this person a line of credit. They don't use it. It just sits there. AKA, we're not making any money. We had to put all the documentation, all of that out there. And so how do we know you're going to use it? So here's what we're doing. He takes $30,000 out for operating expenses. And then
Okay.
over the next week, he's collecting $35,000.
Yep.
Okay. And
Yep.
so what we do is, and so let's just say he collects $7,000 a day. He's moving the income from the checking account against the line of credit. Why? It's an open-ended tool.
And this
And
is
so,
after the line of credit has been used. You've essentially used the whole line of credit against the loan, right? And now you're replenishing it. Am I following that correctly?
well, in this case, no, we're just using it in tiny amounts. We're only using $30,000 at a time.
Okay, because you paid your overhead, you paid your expenses for the month.
Correct. Yeah.
Now, yeah. So
So we
now
take the
you're
money. Yeah, we take the money out in advance.
yes. Okay, I got you. So now you're
And
kicking 7,000 over at this $30,000 balance.
right. And think about it. He pays this off in 4 days. How much
Yes.
interest could you possibly generate on 4 days?
Yeah. Yeah.
And
Correct.
so,
Not that much, right? Okay.
right.
So now he's got his income from his businesses paid off his line. And now
And
how are we attacking this debt?
yeah, so week one, we're paying off the line of credit. Week two, all of that income goes against paying off the debt.
Okay. Yeah, because his expenses, the safety net's there. He doesn't need to worry about stockpiling the income to pay his expenses. That's what the line of credit's for. So
Yes,
now you freed him up to think attack, attack, attack over here. And then when the bills come up again, you just paid off your line of credit. And now you can use it again. And then you just rinse and repeat,
that's
right?
it. That's it. But
Okay, I think I'm getting this. It's a little bit bigger example, business owner example, but I hope that we're catching some of the concepts here.
right.
Because the
But Kyle, I want to really address one of the core key concepts in this example that I gave you. He takes out $30,000 and literally only has a $30,000 loan for 4 to 5 days. On 4 to 5 days, does the interest rate matter?
no,
It's meaningless. That interest rate could be 40%. It doesn't matter. You're not, and this is the explosion part. It's not the interest rate that matters. It's the balance the interest rate is applied to
yes, that's
that
good.
matters.
That is a huge part. It's not the interest rate that matters. It's the balance that the interest rate applies to that matters.
Yep.
I like that. Now, here's the thing that I'm missing here. He paid off the expenses, but he's still got this payment on this big loan. That's
Right.
just the other as he's got the line of credit paid down, now he's just killing the loan payment and more of the loan balance with the rest of the income.
Correct. Because remember, they went from that $11,000 fixed payment now down to interest only at like $1,300 in month one. But that was on a $470,000 balance. Now it's down to
Yes.
200. I don't know. He might only owe like $600 now.
Oh, so yeah, you also did the rework, which you did mention on the existing debt. You kind of reworked that to the banker said, we'll do interest only, and then we'll do
Yeah.
this line of credit. Okay, so there's some really cool levers and knobs to turn with this. But and you said, now if we run this out, now that we've gotten here, he's making that $7,000 a day. The next day after he's paid off his line of credit, he can pay off that interest only payment. And then every day subsequently, he's killing the balance on that $1 million monkey on his back that he wants to get rid of.
Bingo.
Man. Okay, I'm not promising we don't have to do another example, but I'm feeling like we're getting the concept here. And it's all about what you said, making the money move. I want to get into, we're going to take a little break, and I want to get into some